Okay, for part two, we are doing step two, which is a statement of stockholders' equity. So we have in our question assets both our adjusted trial balance again and also the income statement, which we just finished in step one. So as we scroll down here, I want to get out of this, it says that we're going to complete a statement of stockholders' equity for the current year. As of January 1st, Travel Light Corporation has issued 4,500 shares of common stock with a par value of $1. During the fiscal year, the corporation issued 500 additional shares of common stock. The balance in the paid-in capital in excess of par on January 1 was 8,000, and as of January 1st, Travel Light had not issued any shares of preferred stock. During the fiscal year, it issued 500 shares of $10 par, 5% preferred stock at par value. When appropriate, we can just enter in zeros. So again, I'm going to adjust my question assets so I can see everything here in the screen. And I'm going to scroll down a little bit. And again, they have our heading already made for us, but it is Travel Light Corporation, our statement of stockholders' equity. And again, a statement of stockholders' equity is done over the course of a fiscal period. So again, we would have for year ended, for month ended, etc. So the first thing we do on a statement of stockholders' equity is to talk about our capital stock in terms of it being common or preferred. So we have capital stock common here, the dollar par value. So it said that on January 1st of 20XX, or whatever the date happened to be, we had 4,500 shares that were issued. So since we have 4,500 shares at $1 per share, that would be 4,500. And then we also issued 500 additional shares during the current year at $1. So we put in 500 here, which means that our balance on December 31st with 5,000 shares issued should be $5,000. Okay. Then it talks about our paid-in capital in excess of par. So we need to go back up to our little handy dandy chart here. And it says that we had, on the beginning of this year, we had $8,000 in our paid-in capital in excess of par. So we plug in 8,000 here. And then it says what was issued during the year. So let's go over to our adjusted trial balance and take a little look-see. Our paid-in capital in excess of par common. This, remember, is at the end of the fiscal period. So this is actually our balance as of December 31st of 20XX. So we plug 20,000 in here, which means that we had to have issued 12,000, which is 20 minus 8, to get 12 here to bring our balance current. Okay. So next up is our preferred stock. So it says that our capital stock preferred is $10 with a par value at 5%. Remember, they're guaranteed that 5% rate of a dividend. And on January 1st, 20XX, we had no shares issued. So this would be one of those circumstances where we would just type 0 in. And then the number of shares that were issued during the current year were 500, but remember that our par value is 10. So we take 500 times 10. That equals $5,000. So our balance is 5,000 in our preferred stock at the end of the year. Okay, so now we have our retained earnings balance. So our retained earnings balance right now has not been adjusted. I mean, it's kind of funny because we haven't messed with retained earnings at all up to this point. So when it asks for what our balance was as of January 1st, it would be this number that's shown here in our adjusted trial balance because we haven't done anything to this yet. Remember that retained earnings I should say, retained earnings is money that the corporation doesn't reinvest. It hangs on to it. So essentially what it is net income. That they've just continued to hang on to year after year, and it grows and grows and grows. So our balance at the beginning of the year was $19,620.70 as shown right here. Okay, then we need to get our net income after federal income tax for the year. So we go to our income statement and we scroll to the bottom, and our net income was $62,068. $62.68. Okay, and then we have to subtract out any dividends that we may have paid during the year. So we go back to our adjusted trial balance and we find our dividends. We paid out $21,600 in dividends to our stockholders. So our net increase during this year is the $62,000 that we had for net income and subtracting out our dividends. So our net increase was $40,468.08. So the balance in our retained earnings is we take that $19,000 and we add it to our net increase for the year, and we wind up with $60,088.85. And the last thing that we need to do is add in our I'm going to close this because we're done with it. Add in our capital stock and our paid in capital and our preferred stock. So we take all three of these, 5,000, 20, 30,000, and add it to our retained earnings balance, and we should get $90,088.85. So that is a statement of stockholders' equity. It essentially just shows the accounts that affect stockholders' equity, which mainly are our common stock, preferred stock, our retained earnings, which remember is net income less any dividends that we pay. And so that is that for our statement of stockholders' equity. So I'm actually going to stop the video here and make a separate one just for the balance sheet because I think that'll be easier. So it's a shorter video here, but part 3 will have our balance sheet and step 3.